So in this video, what I want to talk about is a a huge red flag. If you were getting, or you thought you were getting a high cash value whole life insurance policy set up, a massive red flag is if you have $0 in cash value. If you have a properly set up high cash value whole life insurance policy, you should not have $0 in cash value. Traditional whole life insurance policies, you might see $0 in cash value for multiple years, and your break even point might be 15 years into the policy. For a high cash value policy, it's so important that the agent that you're working with knows how to set up the policy for high cash value. And number two, they're willing and able to do it. And why I say that is because when an agent helps you set up a high cash value whole life policy, they have to be willing to take a pretty steep commission cut. And the way that agents make money on these policies is off of what's called the base premium. That's where the bulk of the commission comes from. So if you have $0 in cash value, what that's telling me is that your agent set it up to where it's 100% base premium because that's what they're going to get paid commission on. So I'm just going to walk you through an example of putting $10,000 into a policy in a properly set up whole life insurance policy versus a traditional or an incorrect setup for a whole life policy if the goal is maximum cash value. Okay? So let's say I was putting $10,000 into a policy. If it was set up incorrectly, I'd have $0 in cash value my first year. If it was set up the right way, that same $10,000, I could have as high as $9,000 available in my cash value. So what this tells me, and this is good to be aware of as a consumer, if you have $9,000 in cash value, that means your agent took a massive commission cut, about 90%, to be able to give you that $9,000 in cash value the first year. If you see $0 in your cash value, that means that agent took that as their commission. Instead of putting it into your pocket, they put that money into their pocket. And I'll share the difference between the two in terms of how much the agent would make in this scenario. And this is just an example. Let's say the agent had a 90% contract. The way this would work is $10,000 in the first example. They would get a commission on the full $10,000. So $10,000 times 0.9 would be a $9,000 commission. If it was set up properly for minimum base premium and maximum cash value, that same $10,000 that's put in the policy, about $1,000 of that in this example would go towards the base premium, and that's what the agent is paid commission on. So you would have in this second example here, where the policyholder has 9,000 in cash value available, the agent would have made $1,000 times by .9, they would have made about 900 bucks on that policy. So $9,000 versus $900. So it's so important that you're aware of that so that if you are working with someone, you can spot that out immediately. Like if you don't have a high liquidity in the first year and your goal is maximum cash value, you know your policy's not set up the right way. So I hope this video helps. If you do have any questions on what I just went over, please leave those questions in the comments below. And other than that, I'll catch you in the next video.